2025 has been a phenomenal year. 2025 has been a phenomenal year for a lot of growth stocks, including a lot of stocks that are in the asymmetric portfolio. The market putting more emphasis on growth stocks like Hims and Hers, like Robinhood, have really helped that portfolio absolutely crush the market so far in 2025 and really over the past year. But I'm not buying every growth stock because valuations are getting very stretched. And that means there's fewer opportunities right now. But that doesn't mean we can't follow phenomenal companies and keep them on a watch list to maybe look for better buying opportunities in the future. So I want to go through 10 stocks today that I am very interested in. These are phenomenal growth companies, but I haven't bought them yet. So I want to go through not only why they're interesting for the asymmetric portfolio, and also why I haven't bought them. Let's dig into it. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. And if you want more from me, check out my newsletter, Asymmetric Investing. There's a link on the screen and a link in the show notes. I've got more analysis there, and that's also where I have the asymmetric portfolio. You get an update on that every single week, and I buy stocks once a month, and I tell all my readers what I'm buying before I buy them. And I also want to thank this video sponsor, Fiscal AI. Fiscal AI is a tool that you're going to see me use a lot on asymmetric investing. It's really the best tool for fundamental research. They've got phenomenal data, all the financial metrics, insider buys, SEC filings. But really what sets them apart is their key performance indicators. They make it really easy to chart the drivers of a business long-term. I'm going to use this throughout this video, so you'll see exactly what I'm talking about here. But if you want to check out Fiscal AI, go to fiscal.ai/ASYM. They're going to give you 2 weeks for free of their pro version, and then you get 15% off. So check that out if you're interested in doing more of your own analysis. Let's dig into the first stock that I've had my eye on for quite a while, and I've totally missed this one so far. That is Rocket Lab. This is Rocket Lab's revenue, net income, and free cash flow chart over the past couple of years since June 2022. And you can see the phenomenal growth rate here, compound annual growth rate, almost 60%, just going absolutely crazy over the past year. But this is why I haven't bought the stock. These negative net income, negative free cash flow numbers. Now, Rocket Lab's business itself, building rockets, their next generation rocket, which is coming up here, their ability to vertically integrate and offer more services to their customers, all that's very interesting. I like the strategy around the business. But what I'm looking for with a company is that you have a good strategy, and then the financial numbers are going to back up that strategy. And what I struggle with here is what's the moat and how are we going to get to profitability to live up to their current valuation? As I'm recording, $21 billion valuation. And you can see here, they are burning about $180 million worth of cash on an annualized basis. That could potentially increase. Their total backlog has also not increased all that much since 2023. So about $1 billion worth of backlog. I'd like to see that be a little bit higher, but with a company like Rocket Lab, yes, it's phenomenal that they are a leader in getting satellites into space, in their ability to build satellites and design satellites for their customers. But I want to see that they're able to actually make a profit. If you look at something like the Gartner hype cycle, this looks like a company that's early in the hype cycle phase. But I want to be buying stocks, but they have a lot to live up to. And so the risk reward is not a solid balance for me as I look at it today. Another company that falls into a similar category is Palantir. Now, I've done a few videos on Palantir here. And what is crazy about Palantir, you can see this in the numbers, priced enterprise value to sales multiple is 111 as I'm recording today. Now, the stock has done phenomenally well since April 2023, up 1,700%. So a 17 bagger over that period of time. But let's look at what's driving those results. The business is not up 17x in that period of time. The compound annual growth rate since 2018, about 30%. If we look at trailing 12-month numbers, that growth rate, and look at their revenue change, you can see that revenue is now growing a little bit quicker than that over the past 12 months, about a 33% revenue growth rate. So that's a really nice growth rate. But let's isolate the price to sales or enterprise value to sales and the price to earnings multiple. You can see this just absolutely crazy price to sales multiple of 112 and the price to earnings multiple 656. Now, again, Palantir is actually profitable. They are a company that we should judge based on its price to earnings multiple because these are actually pretty good margins here, getting close to a 20% net margin for Palantir. But the growth rate that we're actually seeing with Palantir does not justify the 110 price to sales multiple. That is fundamentally the problem. Two things can be true with Palantir. This can be a phenomenal business. It can be a steady growth business. It can be even a business that's going to grow faster than 30% over the next 5 to 10 years. And it can be overvalued. So the key with asymmetric investing is you want to have companies that can compound their revenue growth, expand their margins long term, but you want to get them at an attractive price. For example, I own Hims and Hers. Hims and Hers is actually growing faster than Palantir. Their price to sales multiple is about 6. So that is a much better price to be paying because those multiples can be a tailwind where they are not going to be a tailwind for Palantir. They're likely to be a headwind the company's going to have to grow into over the next 5 to 10 years. So that's why I don't think those two are asymmetric stocks today. Another stock I'm very intrigued by is Oscar Health. Much smaller company. So again, I like smaller companies because they typically have more asymmetric potential than when you're paying over $100 billion market cap like you are with something like Palantir. So $3.8 billion market cap, the enterprise value is actually only $1.9 billion. So potentially a lot of upside there, especially given the fact that you have a profitable company. PE multiple is just 33 today. They've also been a steady growth company. Compound annual growth rate, about 80% since 2019. Not quite that high over the past year or so, but still a very, very solid growth rate. If we just throw the growth rate here, 54% in the past year. But this is Oscar's most recent presentation, and this just shows the challenge for the business. Medical loss ratio, about 80%. So 80% is where you're going to be capped with the ACA. You have to spend money. You have to spend 80% of the money that you're taking in. So this is an appropriate level for them to be at. But then your SG&A expense ratio has to be under 20%, and it's not currently under 20%. So I know the company wants to get to a 5% operating margin. And I think that is a great goal. If they're able to do that, this would be a phenomenal growth stock. But the challenge with a business like this is they're trying to go into a business that's already established in the healthcare insurance business. And I don't fundamentally understand how they're doing something that's completely different than anybody else. Whereas, again, I'll use Hims and Hers as an example. That is a company that said, you know what, we're going to build this business without insurance. That is disruption. That is doing something completely different. Oscar is not fundamentally doing something completely different. They're still doing insurance. People still have to buy their insurance. They still have to go to the doctor and use insurance. Yes, it's possible that they're a little bit more efficient in the long run than some of their competitors, but we don't actually see that in the numbers yet. Now, all that said, this is one that I'm probably watching a little bit more closely because that upside potential is really there for them. If they are able to grow at a 20% compound annual growth rate, if they are able to get to a 5% operating margin, this would be a phenomenal asymmetric stock. So maybe a little higher on my watch list than the two that I have talked about previously. Lemonade sort of falls into the same category. And let's just start with a simple chart, revenue and operating income. Now, this is an insurance business. An insurance business should be profitable. You're either going to make money on the float or you're going to make money on policies. So this is going to be basically the policy income that you have. And you can see that they are losing money, $211 million over the trailing 12 months. And here's the thing that I just can't get over with a company like Lemonade. In pink, what you see is their total revenue. So over the past 12 months, $559 million in total revenue. They're selling general and administrative expenses, $415.5 million. That means that they are spending far more to acquire customers than they are generating in value. Now, I know it's very possible that the long-term value, LTV to customer acquisition cost, CAC, LTV to CAC ratio is what companies like this always try to talk about. Now, it's difficult to say exactly what the LTV, the long-term value of a customer, is going to be when you don't have a long operating history. This is a company you can't go back 5 years and say, you know how profitable a customer is? Well, we're going to take the numbers from 2020 and then extrapolate that over the next 5 years. You have a completely different cohort coming in 2025 than you had in 2020. So I think it's very difficult to look backwards at the numbers and see profitability. So again, I'm interested in how Lemonade is doing things differently. I'm interested in the way that they're using artificial intelligence, the way that they're a digital first company, unlike a lot of the traditional insurance companies, even the progressives of the world, which are much more internet based than some of the older insurance companies. But until Lemonade proves that it's actually profitable, this is probably a stock that I'm going to stay away from. I know that this is a popular one, but I just want to give an idea of why I stay away from certain companies, even though they may be popular, they may be growing extremely quickly. There's a reason that they don't end up in the asymmetric portfolio. In the case of Lemonade, it's because I don't see the profitability. And until the company turns that corner, we start to see those margins expand. You start to see this blue column bend up towards profitability. You start to see operating margins, not flatline, but actually improve. And again, I'm just going to use hims and hers as an example. This is since 2022. You can see steady growth on the bottom line, steady margin expansion. Look at that margin expansion, and management says that margin expansion can continue till we get to, let's say, 15 or 20% or so. So that's what I'm looking for in a company like Lemonade, is actual proof that they can get to profitability and then have some operating leverage on the business. Until we see that, I don't like the risk reward of that stock. Let's go to another one that has gone absolutely crazy. This is AST Spacemobile, a nearly $13 billion market cap for a company that is generating $4.6 million in revenue over the past 12 months. Now, there are reasons for that. They are just launching their first satellites. They're going through kind of the test phase right now, and they're looking to scale the business over the next few years. So it's very possible that that revenue really starts to ramp up in the next few years. But you got to make a lot of projections to get from losing $326 million over the past year to actually being a profitable business. And again, if you look at the Gartner hype cycle, this is a classic example of a stock that has a ton of hype behind it. They can announce partnerships and the stock will go up 20, 30%. But step back and look at the fundamentals of the business. This is a telecom business. This is a hyper-competitive business that typically has not treated investors very well because they have to put very expensive assets into service. Typically, that's meant building towers, putting assets on towers, 4G, 5G, you got to upgrade all the time. In this case, you're sending satellites into space, and those satellites don't last forever. They're only going to last 4, 5, 6 years, and then they're going to fall back to Earth and have literally zero value. So you're going to have to generate a return on that asset extremely quickly. We do not have any proof yet that they're going to generate a return on that asset. So this is still a very speculative stock. As much as I want asymmetric returns, I don't want to be speculating on companies that haven't proven the ability to make a profit or even make any sort of returns or even show how they're going to make money long term. Most of the revenue is partnerships where they're putting the capital up to put these satellites in space, but they're sharing revenue with their mobile operating partners. Guess who's taking less risk in that case? It's actually the mobile operating companies. So it's going to be really interesting to watch this company over the next few years, but not one that I'm looking to speculate on, especially at this price. Let's look at another one, a $9 billion market cap for Oklo. They don't even have a revenue line here in fiscal AI. So they're just going to tell you what the operating loss is, $63 million. The net income is basically the same, but it's clearly losing money. We are not going to see any functional revenue from nuclear power plants from Oklo for potentially years. Potentially, it's going to be well into next decade. So again, just a speculation that I am not going to invest in because I don't know what the moat is going to be or what the return on invested capital is going to be. This is a stock that can go from somewhere around $6 per share in September 2024 to 10x that and could go back down again 90%. We saw that during 2022. I do not want to be the bag holder if and when that happens. NuScale Power in the same boat. Almost a $6 billion market cap, no real revenue to speak of, $49 million worth of revenue. But let's put their net income here on their negative $134 million worth of losses over the past 12 months. Again, a speculative company that I'm not interested in buying until it proves it is able to make a solid return on invested capital. This is an energy business. The energy business is about what are you investing and what are you getting out of it. There's not network effects. This is not a two-sided market. This does not work like a typical technology company. So we have to evaluate companies based on the industries that they're in. A telecom company like AST Spacemobile, nuclear companies like Oklo and NuScale Power, they need to show that they can generate a return on investment. And until they do that, just not interested in. And speaking of hype, let's talk a little bit about quantum computing. This is a business that could potentially be very large years from now, but we simply don't have evidence that there is going to be a lot of revenue generated from these companies, at least yet. But $3.7 billion market cap for Rigetti. Let's look at their revenue, net income, and free cash flow. Let's put all those on a chart. Look at this, $9.2 million in revenue, free cash flow, negative almost $60 million over the past 12 months. Net losses, $138 million over the past 12 months. Again, this is a very speculative company. And quantum computing is likely to be very competitive, at least over the next few years. And we just simply don't know what the returns on these kind of investments are going to be. And I don't know how to judge which company is going to be better than the next. So you might like Rigetti or Ionic or Quantum Computing. Let's go through those stocks as well. This is Ionic's numbers, $43 million in revenue over the past 12 months, $324 million in losses, and $135 million in negative free cash flow. So that's not very good economics. They're going to need to raise more capital to survive in the future. They might have really great technology, but I just don't see financial results that show me that they're headed in the right direction. Quantum Computing, same thing, $2.7 billion market cap, essentially no revenue, $45 million in losses, $23 million in negative free cash flow. So these are speculative companies, and you need to know where you want to invest in the market. If you want to speculate on companies that you might think are going to be hot, that's just not the way that I invest as an asymmetric investor. I want to know what companies are going to be able to compound their revenue, their net income, their cash flow, and expand their market power over the next 10, 20 years. Those are the kind of companies that I'm investing in. And each quarter, I'm checking on, are they performing well? Are the financials backing up the strategic rationale for owning those companies? And if they do, then I continue to hold them over a long period of time. It's a very simple way to invest, buy great companies and just hang on to them for a long period of time. Some of the stocks in the asymmetric portfolio are already up over 500% because I have just bought companies at a good valuation and then allowed them to grow into it. But I'm not interested today, in the middle of 2025, chasing speculative stocks that have extremely high valuations. That's not the way to beat the market long term. And since I'm not a day trader, I'm not going to be chasing these kind of companies, but that doesn't mean they can't be on my watch list. Some of these companies have really interesting operations. Rocket Lab, Palantir, Oscar, Lemonade. These are companies that I could see owning in the future for the right price. But until either the price comes down or their operations get a little bit better, they're not going to be in the asymmetric portfolio quite yet. But let me know what you think about those 10 stocks that I went over today. Is there some that you're a little more bullish on? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing, my newsletter. Like I said, that's where you're going to see everything from my portfolio. You can see how that has beaten the market over the past 2.5 years since I started it. And I started that portfolio from zero. So showing my work on building a portfolio from scratch. And thanks to our sponsor, Fiscal.ai/ASYM. Like I said, try that out for 2 weeks for free, and then they'll give you 15% off. Thanks for watching, everybody. We'll see you here next time.